New Level Realty is Freedom Friday, and we got a good one for you. In light of tax season, I wanted to come to you with some tax strategies that should help you out, especially for my real estate investors out there or aspiring to be real estate investors. The tax benefits are one of the critical items. It shouldn't be the end all be all for your investment strategy, but it's a big nice to have, knowing that your investment is also going to have a really good tax benefit built into you as well. So just to recap, I've said this on other videos before, the three categories that the IRS classifies your income. OPP, and no, we're not talking naughty by nature. Shout out to Tretch. But OPP, O standing for ordinary income, P portfolio income, and the last P, passive income. And ordinary income, or active income, if you will, is the income that you make when you trade your time in for a paycheck, right? So your W-2 employee, if you're getting a paycheck, that means you're actively trading time for money. Nothing wrong with that, but the IRS classifies you as ordinary income, and unfortunately, it's the highest tax rate. I think the new tax law or Tax Act of 2017 did drop the highest tax rate. I think it went from 39 to 35, but don't quote me on that. But it is still taxed at the highest rate. Next, you have portfolio income, and that's your capital gains from selling stock or selling property. As long as you've held that asset for a year and a day, you're classified as capital gains or long-term gains. And that tax rate is capped at 20%. So if Warren Buffett goes out here and sells some of his stock, he's only going to pay 20%, in theory, 20% tax on whatever he sells. And then if you're, lower than Warren as far as income is concerned, it goes for 15%. And I think it used to go from 15 to 10 to 0. Now I think it's just 15 to 0, but I have to double check on that. So that's portfolio income. And lastly, you have passive income, which rental income is classified as passive income, and that's what you want to, be classified when you're a real estate investor. And trust me, there's nothing passive about the income. Like, I still work hard, and people in the profession still work hard. But from an IRS standpoint, it's classified as passive income, which means you're not technically working to get the rental income. It's passive for that purpose of the law, of the tax law. But that's where you want your income to be classified as. It's passive, and you want it to be classified as passive because you're going to be able to take advantage of some of the things that we're going to walk through in a few seconds here. So first up, we have depreciation, and you've heard me talk about depreciation 1,000 times. It's a really good benefit for real estate investors. And I keep saying real estate investors because there are two different types of real estate investors. There's a real estate investor that still has W-2 income or portfolio income or whatever, and they have rental properties on the side. And if they don't, and there's like 3 or 4 categories that the IRS tests you to determine whether or not you're a real estate investor or not. But 9 times out of 10, if you have a full-time job doing something else, then you're not going to be able to qualify as a real estate investor. Now, you can still take advantage of what we're going to walk through, but you're not going to be able to take advantage fully. And we're not going to get into that side, but for all intents and purposes, I'm going to call everyone a real estate investor for the purpose of this video. But okay, so depreciation, we talked about that. Now, before we get into depreciation, okay, there's 2 types of expenses that real estate investors will be able to take. Okay, so as an example, let's say that you're getting ready to paint one of your rooms in your rental property, right? You go to Home Depot or Lowe's or whoever you go to, and let's say you buy paint, you buy painting material, rollers, brushes, all that good stuff, the overalls to cover up your clothes, gloves, and all that, and it costs you $300, okay? And then you go paint the room. All right. And let's say you did it in January. Okay. Let's say you did it this month. And let's say within this month, you collected $1,000 from rental income. Okay. So you had $1,000 of rental income. You're going to be able to deduct that $300 that you just spent at the store getting your painting equipment within that month. And you'll be able to take that expense within that year. Sounds great, right? $1,000 minus the $300 that you spent. You're only going to be taxed. Your tax obligation, at least for this month, would be $700 in theory, okay? Then there's another expense called capital expense, okay? And let's say you're still within January, right? And instead of going out and buying $300 worth of painting equipment, let's say you had to replace your HVAC, your heating and cooling system. Okay, let's say you had to get a new compressor, the whole gamut. You had to change out the ducts. You had to bring a contractor in to do the work. And all of that work with the labor and everything and materials cost you $5,000. Okay, now that's considered a capital expense, which means you're not going to be able to deduct that full $5,000 this tax season or this tax year. You're going to have to do what's called depreciation, depreciate over time. And I believe for an HVAC that might be classified as a 10-year useful life, which means you have 10 years at $5,000. And that's great because that's quick, simple math. It means you're going to be able to deduct $500 per year for that expense versus that full $5,000. Okay, so that's expense versus capital expense, and that's where depreciation comes in, because if you have a capital expense, that means you're going to depreciate over time that particular asset, okay, or that particular item. Now, think of a house or a building as having systems or teams, right? Let's say you buy $1 million building, okay? Now, within that building, you're going to have windows, right, which is a system. You're going to have a roof. You're going to have HVAC, which is your heating and cooling, electrical, plumbing. All of those are systems. Now, theoretically, you can depreciate, which you wouldn't want to do, but you can depreciate all of those systems as one, meaning the building itself, it costs you $1 million, and you can depreciate that $1 million over 27 and a half years, because a building, and we're just talking residential properties. So let's say a house or an actual apartment building, if it's used for residential purposes, the IRS allows you to take, or it gives a useful life of that building or that house 27 and a half years, which means every year for using straight line depreciation, you're going to be able to depreciate the same amount of a depreciation expense per year for 27 and a half years. Okay, now that's the building and all the systems in it. Okay, now there's something called, and we're going to get to bonus depreciation in a second, but there's something called cost segregation, and we know what the word segregation means. That means to separate. So if you're going to take that same building, which costs you $1 million, and we're going to, use the same systems, your windows, your roof, plumbing, electrical, HVAC. If you separate out those items, now it's tedious to do, but it's going to benefit you. If you separate out the cost, so the windows cost me $10,000. The HVAC system cost me $20,000. My roof cost me $30,000. Plumbing costs this, costs that. Now I'm able to have a different depreciation schedule, and it's usually going to be, well, not usually, it's always going to be shorter than the building, because the building is the highest depreciation schedule you can get for residential real estate or residential buildings. 27 and a half years. That's the longest schedule. Everything else is, I think, 15 years, 10 years, 5 years, and then you can expense it in the same year. Okay, so when you cost segregate out those items, the windows, the roofs, the structure, the landscape, all of those things have different schedules. You're going to be able to take a much bigger expense within that year. Okay, so it's key to do that cost segregation. Yeah, it might be painful. Yeah, I got to do this. But it's going to be very beneficial for you in the end. Now it's going to bring me to my first point, which is bonus depreciation, which is a new thing put into the tax law in 2017. Okay, now going back to that example of the HVAC, and I would have to depreciate it over the length of the 10 years. Well, bonus depreciation allows me to take that expense in the first year. I can 100% depreciate that item instead of going year after year, taking bits and pieces. I can depreciate that full amount within that year. And that's critical for people who have massive incomes, or let's say you sold a couple of your buildings and it netted you a capital gains amount of $600,000 or $300,000 or $400,000 or whatever the number is. Well, if I go out here and if I cost segregate my items, I could take that full bonus depreciation within that year, and I can really hit against that capital gains expense that I had to incur. Okay, now you're going to want to consult with your CPA. Okay, because I'm not a CPA, but I play one in this video. Okay, so you definitely want to go to consult your CPA, but and make sure, another little tip, make sure your CPA is sound in real estate, right? Because you can have a CPA and they're doing the, oh, you have 5 kids, that's a deduction, you donated to charity. Like, they're doing that type of taxes. You want a CPA that is skilled in real estate, because they're already gonna know about bonus depreciation, about cost segregation, and how to really, they're gonna give you an overall tax strategy on how to hit against your passive income, so you're paying essentially zero in taxes. So you're definitely going to want to consult your CPA. Contact me. I have a great team, a great CPA company that are bulldogs when it comes to this stuff. So they can give you great tips. Last thing I want to talk about is the pass-through incentive, again, for real estate investors. And now it gets phased out. So again, you're going to want to consult your CPA, because it can get a little convoluted. If you make more than $150,000, you're going to get phased out of this thing. So you don't even have to worry about it. But if you make under $100,000, you can take the full 20%. And I'm going to give you a quick example of how it works. So let's say that you brought in $30,000 of rental income for 2019, right? And you did your depreciation, you did all your other expenses, and you had $20,000 worth of expenses. So you have your $30,000 minus your 20. Now you're left with $10,000 of reportable income, okay, that you have to pay taxes on. Well, the pass-through, if you're under $100,000 of income, will allow you to take the full 20%. You would take you would deduct 20% off of your taxable income. So that $10,000 minus 20% is $2,000 of expense that you can now deduct from the $10,000. So that would leave you with just $8,000 to report to the IRS. So the pass-through could be really good if you fall within those income limitations. And lastly, I want to say, don't worry about taking the bonus depreciation within that year. Like, so for instance, I said if you had a massive tax hit, right? Like, you sold one of your properties and you got this big tax bill, and you want to do bonus depreciation to make sure you hit against that income for that particular tax year. Well, let's say you didn't have a big tax bill and you're able to just do normal depreciation without cost segregation, and taking the full amount of depreciation for that year, and you're still able to get to close to zero because of your passive income and all your other expenses. It's still okay to take that expense for that year, because even though you're not going to be able to use that expense, because at the end of the day, if you're at zero of income and you have, say, $30,000 of expenses, well, the government's not going to write you a check for $30,000 worth of additional expenses. But what the government will allow you to do is carry forward that expense to the next tax year. So let's say the next tax year, you carry that $30,000 of expense over, and now you do have this big tax bill because you sold one of your properties or you sold some of the assets. You can use that $30,000 to continue to hit against that income all the way until you basically, until you have no more expense left. So it's still a powerful tool to use. So you're definitely going to want to get with your CPA team, make sure they understand. And lastly, I'm gonna leave you with this. Even though you're going to have an accountant and a CPA on your team, which is critical, you're going to need that, you still want to be educated in this. Because what I basically do is I've, read the tax law, and I also read some books out there that kind of dumbed it down as well, because, Congress puts in all that fancy language just to confuse you. But you can get you some good books out there that can break this stuff down for you. But I like to learn it for myself, because I like to be educated and have healthy discussions with my CPA team, just to make sure we're all on the same page. And maybe they missed something, right? Maybe I read something, they didn't catch it, and I said, well, hold on, we can do this or we can do that. But if I don't know anything, and if I'm just relying 100% on the team to know it all, well, then if they do miss something, I'm not gonna be able to catch it, or I can't bring up something that I learned and have a healthy discussion around it. So you still want to know this stuff for yourself. You don't have to know the weeds and know all the ins and outs and the schedules and all the pretty math that goes with it, but at least be intelligent enough to, when they do bring up this stuff and have these reports and they do their tax strategies for the next year for you, you can have a healthy discussion and say, yeah, okay, that makes sense. And I did read this and that, boom, 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 and everything works for you, okay? New Level Realty Hopefully this helps you for tax season. If not this year, definitely going forward, because you want to have a good tax plan, good tax strategy to go right along with your investment strategies. Okay. New Level Realty. Thanks.